Welcome to today's Explainer. We're investigating a massive, silent shift that has completely fundamentally altered the global financial landscape. We're going to dive right into the shocking reality of modern emerging markets. We're going to peel back the labels on some of the most popular global investments out there, and what we're going to discover is that what you think you're holding, well, it might not actually be what you own.
Okay, let's dive into this. When you hear the phrase emerging markets, what exactly comes to mind? For decades, this asset class was a widely accepted shorthand for a very specific type of investment. You're probably thinking of vast commodity exports, heavy traditional banking sectors, and the rapid industrialization of China. But is that actually still the case? If you hold an emerging markets index fund in your portfolio right now, what is literally driving your returns?
Our first major clue in this investigation is absolutely staggering. In just 15 years, from May 2011 to May 2026, information technology skyrocketed from roughly 13% to a dominant 43% of the entire emerging markets benchmark. Meanwhile, the old industrial core was just hollowed out. Energy plummeted to 3% and materials dropped down to 6%. The industrial heart of emerging markets has been entirely swallowed whole by tech.
To understand what this actually means for your money, here's our roadmap for today's Explainer. We'll cover 1. The quiet transformation, 2. Anatomy of the shift, 3. The concentration reality, 4. Unpacking the AI connection, and 5. The practical portfolio test.
Starting with Section 1, the quiet transformation. Honestly, the historical perception of emerging markets as this broad, commodity-driven diversifier against the US, it's entirely out of date now.
And this brilliantly illustrates the new reality. The old shorthand investors used for years, the old EM of commodities, traditional banks, and broad China exposure, is pretty much gone. Today, the new EM means you're buying heavily into Asian technology and AI hardware. The diversification hasn't completely disappeared, but its source has completely changed. You're getting way less sensitivity to commodities and far, far more exposure to the global electronics cycle.
Moving on to Section 2, Anatomy of the Shift. So how exactly did this massive sectoral overhaul happen right under investors' noses?
Well, the data points to 4 primary drivers. First, the index became fiercely Asia-centered. By July 2026, Taiwan, China, South Korea, and India represented roughly 80% of the entire benchmark. Latin America and emerging Europe just play a much smaller role today. Second, market cap-weighted indexes inherently follow the winners, right? And tech companies simply created more market value through superior earnings and growth. Third, the commodity complex saw a massive relative decline after the earlier commodity supercycle ended. And fourth, pure index mechanics played a role. For example, Russia was removed from the index at an effectively zero price in March 2022 after the market became uninvestable for international institutions, and various GICS sector reclassifications shifted how internet companies were actually categorized.
But wait, scratch that. Before we just declare emerging markets a pure technology index, we really need a crucial so what check here. It's super tempting to hear that 43% information technology number and assume it's all just computer chips. But IT is not strictly synonymous with semiconductors. Samsung Electronics, for example, is a massive part of this index, but they aren't a pure-play chip company. They sell smartphones, appliances, the whole shebang. The benchmark also still contains really large allocations to financials and consumer businesses.
Which brings us to Section 3, the concentration reality. We need to peel back the next layer of the onion and look at just how incredibly top-heavy this index has become.
Now, what's really interesting about this slide is that out of an index tracking literally thousands of equities across 24 countries, a tiny handful of passengers are now steering the entire bus. TSMC alone makes up over 15%. Samsung Electronics is over 7%, and SK Hynix is nearly 6%. Combined, just these 3 Asian hardware giants account for over 28%, nearly a third of the massive global emerging markets benchmark. That is near a 20-year concentration high.
When you separate the economic reality from the headline numbers, you arrive at exactly 24.3%. That's the actual direct, listed semiconductor exposure of the MSCI Emerging Markets Index. It's an economically massive number, basically representing a quarter of the benchmark. But it highlights exactly why precision matters. It's 24.3%, not the 43% broad IT headline. You're heavily exposed to semiconductors, for sure, but it's absolutely vital to know the exact weight. Okay, Section 4, Unpacking the AI connection. If we're talking about semiconductors and concentration in 2026, we absolutely have to investigate the massive driver behind all this growth.
The AI connection here is very real and economically vital to the benchmark's profits. TSMC manufactures the leading-edge logic chips designed by companies like NVIDIA and Apple. Meanwhile, SK Hynix and Samsung are crucial suppliers of high-bandwidth memory, which is used heavily with AI accelerators. However, the causal chain isn't just one-dimensional. Remember, these companies' earnings also deeply depend on conventional servers, PCs, automotive electronics, and smartphones. So calling this entire exposure a pure AI bet kind of loses some critical context.
And with this heavy AI and hardware exposure comes three very distinct risks you must be aware of. First is concentration risk. A tiny number of companies now dictate the returns for the entire benchmark. Second is cycle risk. This industry is notoriously cyclical, subject to massive swings in capital expenditure, memory contract pricing, and inventory capacity. Third is geopolitical risk. This includes direct Taiwan location exposure for TSMC, as well as regional trade controls and supply chain policies affecting Korean memory companies.
To really understand the financial stakes of these risks, get this. TSMC had a staggering gross margin in the first quarter of 2026 of 66.2%. The profitability of these hardware giants right now is undeniably historically strong, but it sparks a massive debate among analysts. Is a 66% margin the new permanent structural reality of the AI age, or is this just an unusually favorable peak in a highly cyclical industry?
Because of these peak margins, these stocks might actually look cheap on paper right now, but that can definitely mislead investors. If you're a structural bull, you believe AI demand is highly durable and returns will permanently stay above old cycles. But that case breaks down if competitors build capacity too fast. If you're a cyclical bull, you think earnings stay strong for now, but margins will eventually normalize. The trap here is that markets often mistake peak earnings for permanent earnings. And if you're a bear, well, you believe AI spending slows and memory pricing falls, meaning those incredibly high margins are going to compress rapidly.
Let's move to our final section and see how this builds into Section 5, the practical portfolio test. Now that we've diagnosed the quiet transformation, the concentration, and the real AI risks, how do you actually apply this to your own money?
Well, here are 3 concrete steps to audit your own portfolio today. Step 1, check for overlap. If you use emerging markets as a diversifier, but you already own a lot of US tech like NVIDIA or Broadcom, you might just be doubling down on the exact same AI infrastructure theme without realizing it. Step 2, if you want tech exposure, size it intentionally. Truly understand the difference between foundry exposure, memory exposure, and broader electronics. And step 3, reevaluate your broad EM strategy. A standard cap-weighted index might not give you the balance you want anymore. You might need to look at active management, equal weight, or capped indices to truly diversify.
So, the crucial point is this. Do not ask only, do I own emerging markets? Ask, which benchmark, which date, which countries, which companies, and which economic drivers do I own? The label emerging markets has survived, but the portfolio underneath it has transformed into a highly concentrated Asian tech-heavy engine. It reflects incredible value creation, absolutely, but it brings entirely new risks. So I leave you with this question to ask yourself as you review your portfolio today. When you look past the labels on your own investments, are you truly diversified, or are you just buying the same handful of tech giants in a different wrapper? Thanks for joining us for this explainer, and keep asking the right questions.